short selling. You've probably heard the term, and it's one of the most controversial and honestly misunderstood things in all of finance. It's basically a bet on failure, a wager that a company's stock is going to go down. And that brings up a pretty big and kind of pointed question.
Yeah, is it wrong to make money when a company fails? This is the ethical minefield we're about to walk into. For a lot of people, the answer is a hard yes. I mean, it feels like you're rooting for disaster, right? Like you're betting against progress itself. But is it really that simple?
You know the story you always hear. It's these predatory Wall Street types, right? Greedy traders trying to tank a company just to make a quick buck. But as we're about to find out, the real story of short selling, it's a whole lot more complex than what you see in the headlines.
All right, so let's get into the engine room here. Before we can even start talking about whether it's good or bad, we have to understand how it actually works. I mean, think about it. How can you sell something that you don't even own? Okay, so you know the classic advice, buy low, sell high. Well, short selling flips that completely on its head. The goal here is to sell high and then buy low. And the key to the whole thing is that one little word, borrowed. You can't just sell shares out of thin air. You have to borrow them from someone else first. Let's walk through a super simple example to make this crystal clear. Okay, so first, you borrow 100 shares of a stock that's trading at, say, $50 a pop. Step 2, you immediately sell those borrowed shares on the market. Boom, you've got $5,000 cash. Now you wait. If you're right and the stock price tanks down to $25, you then go back to the market and buy 100 shares for just $2,500. You give those shares back to the person you borrowed them from, and guess what? That leftover $2,500, that's your profit, minus some fees, of course. Sounds pretty simple, right? Well, it is. In theory. In practice, as we're about to see, it's incredibly risky. So that leads to the next question. Who's actually out there doing all this shorting? And if it's that straightforward, what's the catch? Trust me, the catch is massive. And the people doing it, they're probably not who you think they are. Okay, check this out, because this is a huge myth buster. When you think of short sellers, you probably picture some villain from a hedge fund, right? But look at this. The vast majority of short selling, it's actually done by market makers and arbitrageurs. And for them, it has nothing to do with betting on a company's doom. It's just a mechanical part of their job. They're the ones matching buyers and sellers, and they'll short a stock for just a few seconds to make sure there's always liquidity in the market. It's less about predicting the future and more like financial plumbing. It just keeps the system flowing. In fact, most hedge funds are actually net long. They bet more on stocks going up, and those funds dedicated only to shorting, they're a tiny, tiny fraction of the market. And this right here, this is where the real danger comes in. Think about it. If you buy a stock, you go long. For $50, what's the absolute most you can lose? $50, right? The stock can only go to zero. Your loss is capped. But when you short a stock, oh boy, there is no ceiling. A stock's price can, in theory, just keep rising forever. And that means your potential loss is literally unlimited. You could end up owing way, way more than you started with. And that leads us to the ultimate nightmare for a short seller. It's called a short squeeze. It is a brutal, vicious cycle. Imagine this. The stock price starts going up instead of down. All the short sellers start to panic. They rush to buy back shares to cut their losses. But what happens when a ton of people all try to buy the same stock at once? The price goes up even more. This traps even more short sellers who then have to buy, pushing the price higher still. You see the problem? It's an explosive upward spiral. It's like a financial pressure cooker, and it can be absolutely ruinous. So, with these insane risks and all this potential for chaos, you'd be forgiven for thinking this is just the Wild West of finance. But it's really not. Let's take a look at the actual rules of the road, and more importantly, the hard data. So yeah, short selling is actually heavily regulated. The SEC has this whole rule book, Regulation SHO, that basically sets up guardrails. For example, your broker can't just let you short whatever you want. They have to prove they can locate and borrow the shares before the sale happens. Then you've got circuit breakers. If a stock drops more than 10% in one day, these kick in and basically hit the brakes on short selling to prevent a death spiral. And on top of that, there are super strict rules to make sure any failed trades get fixed, like immediately. So this isn't a free-for-all. It's a pretty structured system.
Now get ready for this number because it might actually shock you. On any given day, short sales can make up 40 to 50% of the entire day's trading volume. Yeah, almost half. Now your first reaction might be, whoa, the whole market is betting on a collapse. But that number is really, really misleading if you don't have the context.
And here's the crucial context.
That massive 40 to 50% figure, it's not some giant bet against the entire economy. It's mostly those market makers we talked about before, the plumbers of the market. They're jumping in and out of positions in fractions of a second. And all that activity, well, that's what provides the liquidity that makes it cheaper and easier for everyone else, including you and me and long-term investors, to buy and sell stocks.
Okay, so with all this volume, how often does this system actually break? How often do trades fail to deliver? The answer is pretty staggering. The total value of all failed trades on a consistent basis adds up to less than 0.01%. Not 1%, 1/100th of 1% of the entire market's value. It's an incredibly small number.
So when you put it all together, you look at who's really doing the shorting, you look at the rules in place, and you look at those tiny failure rates, the data starts to paint a very different picture. It's a surprisingly stable and regulated system, which pretty directly challenges that popular story of uncontrolled market destruction.
Okay, so all of this brings us to the really big question. If short selling isn't just about destruction and chaos, could it actually be useful? Maybe even necessary for a healthy market?
Well, you can make a really strong case for it. For one, short sellers often act like the market's detectives. They're the ones who've historically exposed massive corporate frauds. Think Enron, think Wirecard, when auditors and regulators missed them. By betting against all the hype, their skepticism can bring a much-needed dose of reality to the market, which helps make stock prices more accurate, and can even prevent those dangerous speculative bubbles from forming. And here's a wild twist for you. Who do you think lends out all these shares to be shorted? Very often, it's huge pension funds. So, in a weird way, the pessimists betting against a stock are actually helping to fund the retirement of all the optimists.
So when you boil it all down, short selling is really a double-edged sword. On one hand, for an individual trader, it's an incredibly high-risk gamble with the potential for just devastating losses. But on the other hand, for the market as a whole, it can be this vital tool for efficiency, for keeping prices honest, and even for holding corporations accountable. And that leaves us with this one final thought to chew on. The stock market, over the long run, has always trended upwards. It's built on a foundation of optimism and growth. So in a market like that, what is the true value of betting down? Is it just a destructive act? Or is that dose of professional pessimism the very thing that keeps the whole system honest? The thing that exposes fraud, pops the bubbles, and ultimately creates a healthier balance for everyone? That is the complicated truth about short selling.